Hi there, this is Mark McRae, and what's the difference between growth and yield? So if you have any kind of success as a business owner, hopefully you're going to have surplus cash. That should be reinvested into your business, but you will reach a point where you have to do something with the extra cash that you got. And then you're looking for, and it's the same with shares as it is with property. They kind of fall into this growth or yield thing. So I want to talk about both of those today, and if you're lucky, you get something that grows and has a good yield. So in the case of property, for example, let's say you bought $1 million property, and if you took off all of the expenses, the rates, the water, any body corporate fees, anything that would, if you had bought that property cash and you deducted all of the expenses, how much would you be left with? So for example, if you deducted all of the expenses and you're left with $50,000 per year, then your yield is 5%, right? So you have $1 million investment and you make 5% on that $1 million investment with the leases that you have, whether it be commercial or a residential property. So now let's look at growth. So a lot of people, particularly if you're younger, it's not such a bad thing. As you get older, I'm looking more and more for yield, more and more for cash flow than I am for growth, because I might die before something actually gets me decent growth. But let's say that you have had a look at property and it has historically in that area grown at 10% per year. So it will probably be lumpy. In other words, year number 1, it might be 15, year number 2, it might be 5, and so on. It'll be like a chart. It goes up and down. But the average over, say, 10 years would be that it has increased in value by 10%. Right, that's growth. Now, like I said, first prize is if you can find something that gives you growth and yield, right? So, and a lot of the better properties, whether they be commercial or residential, you don't get that great of a growth in yield because people have already factored that in. If you've got like a AAA, really good quality property, it's quite a well-known, quantity. And it's the same with shares, for example. What is the dividend yield each year? So a lot of people will invest in shares specifically for yield, especially if they're retired. They're looking for shares that are going to pay out a dividend each year, as opposed to buying a share in the hope that it goes up. And there's nothing wrong with any combination of that. But you've got to decide if you want certainty, then you're really looking for cash flow. You're looking for yield. If you've got a long enough runway and you've got the capital behind you, you could buy something in the expectation that it's going to go up. So I'm in constant search of yield. I'm looking for things that have yield, and it could be anything from art to barrels of whiskey to property to bonds I'll look at anything where I think I can get a decent yield without too much risk. And you can get complicated and you can figure out exactly what the risk parameters should be based on, say, a 10-year treasury bond. But, if you simplify it, just think about what is the point of building a huge business? You get this money and you want to put it into something else eventually. And those other things have to give you something back. You should never buy something just for the sake of buying it. What's the result that you're trying to get? Are you trying to get growth? Are you trying to get yield? Or are you trying to get both things together? I'm not giving anybody financial advice. I'm just telling you my personal opinion on how investments work. So generally, the lower the yield or growth, the more secure it is. If you go the higher up the yield curve you go, the riskier it is. It's a mathematical equation. So, bonds that are very high risk are going to pay a higher premium than bonds like government bonds that are very low risk. But some of your time should be spent thinking about how do I invest the money that I have? And I'm not suggesting you should talk to me about it. Go talk to an expert. And make sure those experts actually invest themselves. So early on in my business career, I fired all of the experts. I would give them X amount of money, and at the end of the year, they would give me back less. I mean, it's like a talent. I mean, I can do that. Rather go to the casino and have a good time or just throw the money in the air. If they can lose money, what's their point? And the other thing is, most investment advisors are going to charge you an arm and a leg in fees. You might find that, okay, this portfolio made 5%, but after all the fees, it's like 1 or 2% because they've taken so much. So I prefer, me personally, and it's only for me, to look after all of my investments by myself. There are occasions where I'll call on experts for something specific or some advice in tax for particular investments, but generally, go learn it. It's not rocket science. You know, there's books out there, you've got YouTube, you've got so much free information. You can know as much as the experts in a very short period of time. You put 10, 20, 30 hours into something, you probably know more than 99% of people around you. But to bring it back in again, we're just talking about growth and yield, and each week I'll try and talk about some investment fundamentals. Is you tend to buy things for one of three reasons. You want growth, you want yield, or you want growth and yield, which is, first prize. If you like these tips, don't forget to subscribe, follow, or leave me some feedback. Thanks for listening.